As we said, one of the main reasons behind having low gross margins is excessive markdowns. Markdowns happen mainly for two reasons: to drive sales or to clear merchandise. So if we find that discount rate has been higher than normal this year, we analyze to see if this has been justified. In other words, did the business really need to give so much discount? To check that, we go back to analyze sales versus budget and see if the business was already delivering its sales targets normally without the need for discount. If this was the case, then there was no reason to issue so much discount on the merchandise, unless the next point applies. The second point to check is inventory levels. Chances are the business was delivering its sales targets, but inventory level was higher than targeted. The reason behind this could have been a planning issue, where the business bought too much in the first place. So inventory here did not build up due to slow sales, but rather due to a planning error. In this case, the business did really have to start a series of markdown events to clear all the excess inventory on time and free up cash. In the absence of those two reasons and justifications, there is no reason for the business to have a higher than targeted discount rate. And when this happens, the business ends up having low margins and also low levels of inventory that might affect the sales performance in the future. In some cases, however, the business might be in need to generate cash by liquidating some of its existing inventory. Now that we have analyzed the sales and margin sections of the income statement, we move to the next section, which is operating expenses. While analyzing the overheads of the business, we take the historical data as well as the industry's benchmarks as a reference. Our multi-year P&L statement that we generated at the beginning of this process will show us how each cost line has been developing over time. If we find that a certain cost line has suddenly seen a big increase, we need to investigate the reason behind such spike and whether or not it's justified. Looking at the sample statement that we generated, for example, we find that in 2015, there has been an increase of 80% in selling and promotions expenses, and their percentage to sales has gone from 4% to 7%. When this happens, we examine the cost line further by looking into the different components and checking which component has gone higher and why, and then decide what needs to be done to bring it back to normal. Selling and promotion expenses, for example, include advertising and marketing fees, credit card processing fees, shopping bags, and loyalty points given to customers. Which component has been the reason behind the spike in selling and promotion expenses for that year? And is it an exceptional case, or is it expected to continue that way? For example, there might have been a marketing event due to the opening of a new store. So in this case, for that particular year, the selling and promotion expenses are going to be high, but that's not expected to continue in the upcoming years. Cost lines are expected to grow every year as the business grows, and also in line with market inflation. For example, credit card processing fees are directly proportional to sales since they are a percentage of sales. So if we expect sales to grow by a certain percent every year, consequently, this component will rise proportional to sales growth rate. If the growth is not as expected and justified by these factors, then we need to look further into the causes behind that. When we examine staff cost, we look at the amount compared to the budgeted amount and also compare to historical level. And if we find that it's higher than expected and its percentage to sales is higher than the benchmark, we look into the head count of the store and compare it to the budgeted headcount and the appropriate headcount needed to operate the store. If the headcount is on target but the amount is still higher, we look further into the components of staff costs, especially the variable components such as overtime, and examine to see if such higher amounts are justified. So before we suggest cutting headcount, we analyze to see if we can bring down the variable components like overtime and solve the problem that way without affecting the customer experience on the floor by reducing the number of staff. In many cases, this is achievable through efficient operations and scheduling for the team and through creative solutions like hiring temporary workers during peak seasons only. When it comes to rent, it's pretty much fixed as per the rental agreement with agreed upon annual increases, if any. Problems start to happen when the store is not generating as high sales as before, which could increase the rent to sales ratio to a level that's too high. For example, here in 2016, because there was a 16% drop in sales, although the rent amount was the same as the previous year, this has gone up to become 20% of sales. If we consider that the acceptable percentage of rent to sales is 10% to 15%, then 20% is starting to be far above the benchmark. In this case, if the reason behind the drop in sales is related to the mall itself, as we explained in a previous lesson, it might be time to renegotiate the rental agreement so that the rent to sales ratio could be brought down to acceptable levels. One thing to note here is the case for new stores. When a store first opens and the mall itself is new, sales might be low because the traffic is still building up and people are just getting to find out about the mall. And also maybe the mall is still not fully operational and other brands are yet to open. In this case, it could be fine to tolerate a higher rent to sales ratio, considering that it's projected to come back to normal as the mall becomes fully operational. This is also calculated and factored in the 3 years projections that we make before opening the store. After all the store-related costs and the store depreciation has been deducted from the gross profit the store has generated, we come to an amount that represents the store profitability, namely the store profit. This is different from the total business profit as it doesn't include the common costs of the retail company, which includes warehousing, office employees, financing charges, and company taxes. The reason why it's good to make such separation of store and business profits is to be able to make decisions on store openings and closures. For example, if a store net profit figure is positive, while the net profit at business level contributed to that store is negative, this store has a chance to be profitable if the business opens more stores in the future, because the common costs will be divided over more store locations and this store will be paying lower common costs and hence will be profitable. In this case, if the business is having an expansion plan, the right decision could be to keep the store open if future projections after expansion can show that it will turn profits as common costs go down. However, if the store net profit itself is negative, that's to say the store on its own without factoring in any common costs does not generate any profit, then the business needs to make a decision whether or not to keep the store or close it down because it's not performing. Some considerations to note here before making such decisions are: the store could be new and is expected to see a high growth rate as it matures, and so it's expected to turn profits in a few years. The store could be in a very strategic location for the business and contributing to its brand exposure, so it might be better to keep the store for such benefit. The store could be in a place that it's very important to defend the competitive position of the business. That's to say, if we vacate this property, the competition will be swift to move in our place and take our market share in this area. So there are different reasons to keep an unprofitable store open. When a retail company operates a portfolio of stores, not all of these stores are generating profits on their own. Such portfolio needs to be analyzed on a regular basis to make decisions on which locations are contributing to the business and which ones need to be consolidated or closed down. When a company has many store locations, it's getting a lot of benefits related to scale, such as lower product prices and better terms with suppliers, better store rents and prices from vendors, a higher market share and brand exposure, as well as the ability to divide common costs over a higher number of locations. All this is taken into consideration before making store closure decisions, and not only the net profit at each store.